Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this edition of the Moneymakers Investment Trust podcast, I sit down with Andrew McHattie, the editor of the Investment Trust newsletter, for one of our regular chats about recent news, announcements and developments in the investment trust sector. Other weeks we have interviews with fund managers, analysts and so on, but this is a monthly recurring feature and one I know that is popular with many listeners. So Andrew, let's dive straight in, shall we? It's been another interesting week. We've seen some interest rate announcements of some significance, and we've continued to see relatively buoyant equity markets, but some adverse movements in the bond market. So what do you think, what's been going on this week?
Well, thanks for that fulsome introduction, first of all, Jonathan. And yes, it is an interesting time because often this pre-Christmas period is a bit quieter for markets, but investors always hope for the much vaunted Santa Claus rally, of course. And maybe we are seeing a little bit of that now, helped by those interest rate cuts across much of Europe and Switzerland as well, as though that's been quite good news. In the UK, I think the macro news hasn't been quite so good, with GDP retreating modestly over the last month. But nevertheless, I think the market background has been reasonably benign. And on that basis, we have seen some reasonable price movements in investment trusts, I'd say.
Yes, I mean, it's been actually interesting. It's been one of those weeks where we've seen quite significant moves up and down, otherwise in both directions. There have been some quite significant price moves, and we might talk about those in a minute. But let's first off just kick off with some of the news, shall we? And try and work our way through a few of the notable announcements, ones we picked out. And let's start with Taylor Maritime, shall we? Ticker TMI. This is one of a couple of relatively recent shipping trust launches in the UK investment trust sector. What's the news here?
Well, this is quite an interesting place to start, actually, because I think we've had good and bad news here. The good news, first of all, is that business is quite good in the shipping industry at the moment. And because Taylor Maritime Investments also made some successful asset sales, it has some spare cash. So it's proposing a special dividend for shareholders. So that's an extra 4 cents a share that it's going to pay in the first quarter of next year. And this is on top of what is already a very attractive dividend. So it's already offering you an 8.2% yield. So that's quite good news, actually. And we have seen the shares rally on this. But to my mind, the slightly less good news is that Taylor Maritime is proposing to change sectors and leave the closed-end fund sector. And we have seen this once or twice in the past. It's fairly rare, but I remember Pollen Street, for example, doing this. So this is really, in this case, because Taylor Maritime has developed its business and it's become much more of an operational shipping business after it acquired the Grindrod shipping business. So now that it's an operating business more than an asset owner, it's going to become a fully fledged commercial company. And that's relevant not just because it's switching sectors and tables, but because of the accounting changes that are now going to occur. Because it's now going to present its accounts very much as a business. So it's going to be based on profit and loss and turnover. It's not going to give us NAV calculations anymore. Obviously, stockbrokers in the investment trust sector will cease their coverage. And so that's quite a significant change. And I think we might see some of the existing shareholders leave because they're very much investment trust based. So we'll have to see how this plays out. And I'm a little bit sad. I like this trust, but it's leaving our sector. So we're just going to be left with the one remaining shipping trust, which is Tufton Oceanic Assets.
Right. So this is it. Do you think that the board's attitude or decision here may be something to do with the fact that this particular trust has continued to trade at a big discount? The shares have perked up a little bit since their low point about a year ago. They have rallied along with most of the investment trust sector, but they're still trading at a discount. The share price is, I think, around 98 cents. But they're still, as I say, about a 30% discount, which is obviously disappointing for a company or a business that is doing pretty well.
Well, it can't have helped, can it? And I do think it's a bit of a curiosity, really, that this trust is indeed on a 30 plus discount when it's offering this very nice yield and actually business is fine. It's been reducing its debt successfully. And actually, to my mind, presenting quite a positive picture to the market. So, inevitably, that wide discount and perhaps lack of interest in the investment trust sector can't have helped. So, yes, the board has obviously decided it's likely to achieve a higher market rating, I think, by shifting sectors. And I can't blame them.
We don't want that to become a more persistent trend, do we? Where people actually decide that the investment trust sector is not where they want to be. And I think that's something which I think obviously investors need to think about quite carefully. The implication is if you look at a trust in a different way, not as an investment trust, i.e. looking at the discount, looking at the NAV and so on, but as an operating company, which is what many of the alternatives are now saying they should be treated as anyway in terms of cost disclosure, that would be a worrying trend for the sector, as you say.
Well, I do think this is one to watch because I'm going to be following the share price quite keenly when it makes this transition early next year. Because I do think if Taylor Maritime sees a significant bump upwards in its share valuation after it shifted sectors, that is going to alert other boards to this possibility, isn't it?
It certainly is. Well, let's move on from that one then. Let's talk next about another potentially perhaps significant change. Interesting your views on this one. And this is Greencoat UK Wind, which is obviously one of the oldest and the largest alternatives renewables trusts. And that's also trading on a substantial discount, which is not at all what its recent experience has been until the last couple of years. And they're making changes to their management fee. I think that's a very interesting development because other alternative renewable investment trusts may have to take notice.
I do think this is a very significant development, actually. Partly, as you say, Jonathan, because Greencoat UK Wind is really a flagship trust in the renewable energy sector. It's very widely owned by institutional investors as well as retail investors. And this is quite big news. So what the trust has done, and actually it was a very small announcement it made, it didn't make much of a fuss about this itself, but it's changed the basis of its management fee. So rather than charging its management fee as a percentage of the net asset value, it's in future going to charge it on the lower of its net asset value or market capitalization. And what that means is that if the shares are on a significant discount, as they are at the present time, then the management fee is very significantly lower. And I've seen actually a broker estimate that this is going to save around £5.5 million for shareholders this year based on the current valuations. So I do think this is a really significant shift. And I did note actually last week that Marcus Fairmudge talked about this in relation to the property sector. So it's not just relevant to the renewable sector. And I think this change does mean there's greater alignment with shareholders. It's a fairer structure. I think it's wonderful to see, actually. I really applaud this move, and I hope other boards might follow. I did notice that the AIC said that 32 investment trusts have changed their fees this year to benefit shareholders, and I very much hope that's going to be a continuing trend.
Yes, it is interesting. One of the things that Marcus said last week was that if the shares do go back to a premium, he'd be quite happy to pay a higher fee in that case.
But in this case, because it's charged on the lower of market cap or NAV, you're not even disadvantaged if that happens. So it's a pure benefit to shareholders if the shares are on a significant discount. So in effect, you're getting the best of both worlds. And as long as the managers are happy with that, they still feel they're being paid enough to do their job, then I think it's a great situation.
Yes, I mean, it's fair to say that in terms of shareholders, the market cap of this particular trust is pretty substantial. So in the kind of grand scheme of things, perhaps you could say that $5.5 million a year, that's a lot of money, is more important to the manager than it is to the shareholders in the trust. But it is, as you say, the significance, I think, and the example that it's set to the rest of the sector, that is going to be important. And of course, maybe this just also highlights again the struggles that the renewable trusts in particular are having in restoring their shareholders' confidence, I think one could say, because this year it has been a pretty sorry story for most of the renewables. They've derated substantially, and indeed they're often going to the widest we've seen yet, I think. So this is a significant moment for, I think, the sector, as you say. Do you think that other trusts will have to follow this example?
I think they will now. This is very much on the agenda. I think Greencoat UK Wind making this move has brought it to the attention of everybody. And so undoubtedly, this will be a discussion point for other boards. And I think shareholders are going to be pushing for it. It'll be a question that will arise, I reckon, in almost every shareholder meeting from this point onwards. And it is particularly significant for the renewable sector because I think we've already seen something of a recovery in the valuations in most of the other depressed sectors. So we have seen a jump in valuations actually in both private equity and in property, but we have not seen that in the renewable energy sector. So while it's depressed and in need of some kind of fillip to give it a boost and get it moving, this is potentially one way to help.
Yes, I'm just looking down the list of infrastructure trusts now, including the renewables. And yes, the Greencoat UK Wind is the most highly rated, but it's on an 18.5% discount, which is pretty substantial, given that it used to trade at a premium for most of its life, actually, until about 2 years ago. So that is significant. And then some of the others, of course, are much wider discount, as we know. So that's a very interesting and significant development. I guess one can also say, though, of course, that this is a moment when the renewables, I mean, they do look superficially attractive. They're paying decent yields, well-covered yields in a number of cases, and they're trading on these big discounts. So the question to ask might be, what will it take for them to be re-rated? I guess a lot of it turns on what happens to interest rates, where the recent trend has been towards consolidation, if not higher yields. Would you agree with that?
I do think many investors consider these trusts as bond proxies. So they are comparing the yields available from these trusts against UK gilt yields. And that hasn't helped of late. So yes, I do think actually that in a true environment of falling interest rates, that's going to be a much better backdrop for these. And I think as well, there's just an element of inertia. And I think we've seen this in the private equity sector, which has started to re-rate actually a fair bit. And I can't put my finger on any particular factor that's caused that. I think they just turned a corner. And then as they started to re-rate, people noticed and thought, well, this will be a good time to jump on board. So it's not necessarily going to take any kind of seismic event or shift for these renewable energy trusts to pick up. I think maybe they just need to keep on doing what they're doing, delivering the dividends, and eventually those high yields are going to be irresistible.
I mean, we should say that obviously power prices have been coming down in the short term, and bond yields have been, if anything, slightly higher in the last few weeks. So it has been a difficult background for them. But of course, equally, we haven't seen that much visible shareholder pressure. Obviously, firms like Saba Capital don't get involved in the alternative sector. We haven't seen a huge amount of shareholder pressure on the surface so far, and we've certainly seen very little corporate activity. So it is an interesting situation, which surely has to correct one way or another in due course. Let's move on then and talk about a couple of results, shall we? These are interim results. Let's start with Polar Capital Technology. This is managed by Ben Rogoff. Obviously hugely successful, had a very strong run on the back of the very strong performance of technology stocks. What did you take away from the results announcement?
Yes, a popular trust, this, owned by many, many retail shareholders, so worth following. And its interim results for the 6 months to 31st of October were quite decent. The net asset value total return was up 11.7%, which compares to 14.1% from its reference index. And I don't really mind there's a couple of points behind the index because it's a very difficult index to keep pace with, actually, because, of course, it's dominated by these mega caps. And the problem is that if you have an index weighting in those, you're going to have some very, very high weightings. And in order to maintain diversification, that's not necessarily what you'd like to do. So anyway, I think it was a reasonable set of results. And I picked out a couple of interesting elements of it. One, just to come back to the subject of fees, is that the board has removed the performance fee here, which wasn't being earned at the present time anyway, but performance fees are not everybody's cup of tea, so that's one less reason to worry about investing in the trust. That's no longer going to be charged. The other interesting point, actually, was that I must say this was rather ironic, but I manually counted the number of references to AI in the manager's report, and there were 99 references. So, my goodness, it was heavy on the AI talk. And Ben Rogoff is a very keen proponent of AI developments, and he's a believer in the future here. He calls himself an AI maximalist and says that he is inspired and optimistic about the AI era. So he certainly believes there's a revolution coming here. And for the portfolio, that means he has put more money into semiconductors. It's really the picks and shovels of the AI industry and a bit less in software. So NVIDIA is the largest holding at almost 12% of assets. And I think that's very much where this trust is going to be focusing in the near term. And I think there's some decent value here. The discount is currently about 12%, which has been fairly stable for a while. And that's notably wider than some other ways of getting access. For example, Herald Investment Trust, which has come into a very tight discount of under 1%.
And also, one should perhaps mention that category, Scottish Mortgage and so on, other trusts that have not quite as much exposure to the pure tech trust, but quite a lot indeed. Yes, and the shares here have just about hit an all-time high. They sold off quite sharply, didn't they, over the summer? Remember that dramatic day in August and then the sell-off in these particular trusts. And it's come bouncing back, basically, I think, linked to the kind of Trump election win. But a new all-time high, that's often a positive sign. So, yeah, what do you think the outlook is for this one? It's now, a £4 billion market cap trust. It's done extraordinarily well.
It's very nice to see that all-time high. And I've always thought of Polar Capital Technology really as a classic long-term investment trust holding. I've often been asked about trying to time it. Should I buy now or should I wait until there's some kind of setback in the sector? And I tend to think, actually, if you're able to save monthly, that's a fantastic way of buying a trust like this. But actually, the other approach I think is very reasonable is just not to worry about your timing too much and just have it in your portfolio and sit tight. And the other question I'm frequently asked is, should I buy Polar Capital Technology or should I buy Allianz Technology Trust? And I've been looking at these two trusts for years, comparing them and their performance, and I can't separate them. So I've just said, well, I think you should own both of them.
Yeah, exactly. Well, Allianz Technology also trades on around the same sort of discount and has also just touched an all-time high. So you're absolutely right about that. Okay, let's move on and talk about a much smaller trust that is always of interest to listeners of this particular podcast, and that is MIGO Opportunities. Of interest because this is one of the trusts that invests in other investment trusts and is on the lookout for fairly niche discount opportunities in particular. They produced some interim results, and, well, I'd be interested in your take on this one.
Yes, managed by Nick Greenwood and Charlotte Cuthbertson, who are now at AVI. This is a really interesting trust for us in the industry because it's investing in our sector, looking for interesting situations. And it had a fairly flat period, actually, in the 6 months to the end of October. The NAV was down by 0.6%, so not very much. And it had winners and losers in that time. So it did do quite well, actually, from Cordiant Infrastructure, from Phoenix Spree Deutschland, Tufton Oceanic Assets, which we've mentioned, Amadeo, and a new trust, actually, for it, Aberdeen Property Income, which it bought just before the takeover. And then on the negative side of its balance sheet, it had Georgia Capital, Geiger Counter, and Seraphim Space. So I think it's inevitable when you're looking at these kind of second-line, slightly more speculative trusts, you're always going to have winners and losers. But generally, I think Nick and Charlotte are quite optimistic about the position from here. They're finding, of course, huge amounts of value in the sector. But there was one trust I noted they said they were reducing their holding in because of the Trump election, actually, and that's Vietnam Opportunity Fund, which is a potential problem with the tariffs for them. So should the Trump administration increase tariffs on imports to the US, that might be quite damaging for the Vietnamese economy. So that's something to bear in mind. But nevertheless, apart from that, actually, I think it was quite an optimistic outlook.
And of course, MIGO Opportunities, the board has been quite active in buying back shares. They do have a discount control policy. It's not an absolute one, but they do have one, and they've been buying back quite a lot of shares. So they are doing what they promised to do, which is always good to see, unlike some that don't. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. I mentioned earlier that we've been in an environment now where bond yields have not come down as much as many people were hoping. And that's, I think, part of the Trump election fallout as well. His approach is widely deemed to be positive for growth and equities in the short term, at least, but negative for bonds because of the increasing supply of bonds that will be coming from the US federal government. But this also creates opportunities for investors, of course. And one of those ways that you could buy an investment trust that specializes in debt or debt securities, and one of those is TwentyFour Select Monthly Income. And you've been taking a look at this one. It pays a very nice yield. So what's not to like?
Well, indeed. Now, this is a very unusual trust because it pays monthly dividends, exactly as the name says it will. And that's a rarity in this sector. Quite a few ETFs pay you dividends monthly, but not investment trusts on the whole. But if that's something you're interested in, then this could be worth looking at. It's a difficult trust to understand, actually, because it's investing in some quite esoteric parts of the credit markets. So it's investing in CLOs, in debt, in bonds. And to some extent, if you don't know too much about that, you just have to judge the trust on its performance and record, I think, which is good. It had a very good year, actually. In the year to the end of September, the NAV is up 22.6% over that period. And the yield is very high. It's 8.7% at the moment. So that's certainly an attractive yield. The managers are positive. And there's one other unusual factor about this trust, which is that the shares are trading on a premium. And we can't say that about too many investment trusts. So it's trading on a premium and issuing shares. So this is a trust that's expanding. And that's a wonderful thing to see.
So there's another TwentyFour Income Trust as well, which doesn't pay a monthly dividend. Do you have a favorite between those two? Are you able to compare those two?
Well, I do think to some extent it matters actually how frequently you'd like your money out, because the other trust, I think, pays quarterly, which is much more common. And actually, I haven't looked into them in sufficient detail to understand quite what the differences are in their underlying portfolios. But one difficulty I do have broadly in this sector is that I'm not certain I really have a very good understanding of credit markets because I spend much more time looking at equity markets. And so I think it's very reasonable to look at the track records, see what you think, have a look at the current yield as well. And in the end, you also probably need a little bit of faith.
Yeah. So, I mean, the main difference, I think, is the yield. It's, as you say, over 8% for the Select Monthly Income. And for TwentyFour Income Fund, it is about 5.8%. But you obviously have potential capital gains as well sometimes in that. So I guess obviously these are quite specialist vehicles, as you say, and it's not as straightforward as just saying that you can read across from where interest rates are to how well this is going to do. Let's move on to another interesting trust, but they're a very different vehicle. This is Third Point Offshore Investors Limited, ticker TPOU, which is managed by an American hedge fund manager. Dan Loeb is his name. What can you tell us about this one, and why are we looking at that one?
Another esoteric trust existing on the fringes of the investment trust industry, this one. But it is interesting for a couple of reasons. First of all, it's on a 23.4% discount. And of course, we are seeing wide discounts across many parts of the market. But that's interesting because this trust is actually also doing extremely well at the moment. In the last year, its net assets are up 32.2%, and it's really been delivering. In November alone, its NAV was up 7%. Now, it is a hedge fund. It's effectively a feeder fund into Third Point's primary fund, which takes a long-short equity policy. So it's long of some stocks, including a lot of well-known ones like Amazon and Meta and Siemens and Taiwan Semiconductor. But it does take short positions as well. So it has quite a lot of flexibility. It's event-driven and opportunistic. That's its own description, which means that it will jump around as well. So I think rather like the credit funds we've been talking about, you've just got to have a bit of faith here if that's what you want to invest in. It's not completely transparent. The manager doesn't like giving too much information out, but its track record speaks for itself, actually. It has been a very good trust to own of late. And it's interesting at the present time as well, in relation to that discount, because it's been trying to address this. It had a 25% tender offer in April, but that didn't solve the problem. And the trust decided to launch a strategic review that was intended to conclude by the end of this calendar year. Now, the trust has said that it's going to take a bit longer and it's going to actually report in April, I think, which in some ways is disappointing. But actually, the reason for this delay is that it sounds to me as though there's change on its way. And the trust says it has a major strategic option that it's assessing. And I think there's quite good potential here for that to narrow the discount quite considerably from that current level. And in the meantime, you're in a good trust that's doing well, or it has been. Obviously, past performance doesn't guarantee anything, as we know. It is a dollar-denominated trust, something a bit unusual, so I don't think this is for everybody. It's not really mainstream, but it's certainly one that I'm watching.
Yes, I noticed this too, because I think historically there has been a bit of tension between Dan Loeb, the head of the hedge fund that manages this trust, and some of the shareholders who think that in the past he's been a little dismissive of their interests and concerns, I think it's fair to say. But they do seem to have found religion, or at least the board has found religion, and they've been quite active, as you say, in trying to address the discount. So one does wonder what the sort of underlying plan is, and we'll just have to wait a little bit longer. I'm not quite sure whether that wait should be regarded as good news or bad news, or maybe there's some sort of disagreement maybe between the manager and the board, who knows. But we must watch that one with interest. And this one, obviously, as you say, trades on a discount. How does the discount on this one compare to some of the others in that sector, such as there are left? Who would you compare them to? I mean, would you compare them to Pershing Square or to EH Macro? It's a very different business model there.
Yes, I mean, I think it's quite a tough question. As you say, there are not too many of these hedge fund investments left in our sector. BH Macro, I think, is much more of a traditional, true hedge fund, so it's less equity oriented, and that's on a much narrower discount of more like 8 or 9%. So I think maybe Pershing Square is the most direct comparison. And I think as well, there are similarities there in that it's run by a charismatic individual who's very much the decision maker. And sometimes they go off at a tangent and maybe investors don't really recognize exactly what they're doing and what the end game is. But again, ultimately, it's also been a very successful trust, Pershing Square. And that's on a wide discount, of course. We know it is. It has been for ages. It's on a 30 discount. So I think that's probably the most direct comparator.
And they have been buying back a lot of shares. That's also true in the last couple of years, I think. So one other topic we wanted to cover this week in the podcast, Andrew, and that is, you may have noticed there have been a sort of dribble of results resulting in name changes of trusts which are in some way connected to ESG or sustainability. Can you tell us what's been going on there and which trusts have been involved in that kind of renaming purpose, and does it actually add up to anything in particular?
Well, it is significant. This is all driven by the FCA. The regulator has introduced this new standard of sustainability disclosure requirements, SDR. So that's another acronym for us to try and remember. This is really about introducing anti-greenwashing rules. So it's to stop investments pretending to investors that they're doing great things on the ESG front when they're not. And it's much stricter than it used to be. So that's meant that certain trusts have had to change their names. And I have moaned about this a bit, Jonathan. I admit I've not been entirely happy with this. So, for example, Impact Healthcare REIT, which was named after the manager's Impact, was no longer allowed to use that term. So it had to spend money and time changing the name of the trust to Care REIT. And a similar thing happened actually with BlackRock's Sustainable American Income Trust, which has now dropped the word sustainable and otherwise kept everything the same. So I haven't liked it very much, but there is a point to this, which is to effectively highlight to investors the trusts that actually are genuinely making a significant commitment to green issues. And there are 4 trusts that have actually agreed to meet these requirements, which means they've had to do a lot of form filling. So those are Greencoat UK Wind, Impacts Environmental Markets, Schroeder BSC Social Impact, and the trust that was VH Global Sustainable Energy Opportunities. Rather ironically, even though that's met the requirements, it has dropped the word sustainable from its name. So it's now VH Global Energy Infrastructure with a new ticker code of ENRG. Anyway, there's been quite a lot of name changing going on, but ultimately we have this very short list of trusts that I think are interesting for investors who are looking for that particular angle on their investments.
Yes, which it's fair to say I think has gone out of fashion a little bit. There was a big sort of flurry, wasn't there, 3 or 4 years ago? Everybody wanted to jump on the ESG bandwagon. I think one can perhaps describe it as that. And thought there'd be an advantage to have that in your name or some connection to sustainability in your name. But that's tied up. So you just got to get used to these new names out there. The trusts themselves are basically still doing much the same thing. Finally, then, I wanted to end on a more positive note, perhaps, and talk about, well, if we look at what's been happening in the last 5 days, I've been looking down the list of trust performance. And as I think I said earlier, quite dramatic moves by our standards anyway, across the week. But if you look across the top performers this week, one thing does stand out. There is a kind of growth bias here. And in particular, any trust that's had some kind of investment in SpaceX, which is the space company set up by Elon Musk, has done very well in the last couple of weeks. And it's been generally good, for example, for Schiehallion, which is their growth capital trust, for Baillie Gifford US Growth, and Scottish Mortgage. Do you think this is a sign that maybe the Baillie Gifford style of investment is coming back into favour?
I'm delighted that we're seeing this partial rehabilitation of Baillie Gifford, actually, because my goodness, they received a right kicking over the last few years when growth investing fell out of favour. And we have now seen this really big bounce, actually, in the performance of these trusts. Very much helped by SpaceX, and obviously we're used to drama surrounding most things that Elon Musk does. But there was a very specific reason this week because the company SpaceX decided to buy back shares from employees, which valued it at around 350 billion US dollars. And that's significant because it's up from about 180 billion a year ago and 210 billion at the last count. So this was a big revaluation of SpaceX, and that boosted the assets of these Baillie Gifford trusts really quite significantly. In fact, yesterday, Baillie Gifford announced the news of exactly how much the assets had gone up. So it was 2% for Schiehallion Fund, 3.7% for Scottish Mortgage Trust, 5.2% for Baillie Gifford US Growth, and 5.1% for Edinburgh Worldwide. So these are, in our world, quite big increases, aren't they? And these are not necessarily highly valued trusts. Actually, a couple of them have bounced back to become reasonably valued again. But it's good news, I think. It's very good news if you are a patient Baillie Gifford shareholder, that's for sure.
Yes, I think it is interesting that the share price has performed better than the numbers you just mentioned, and that's because the discount has also come in quite significantly in 1 or 2 of these cases. You know, you could have had them on a discount of 30% or something not so long ago. Now they're trading between 0 and 10. So it's a quite significant move. And indeed, Baillie Gifford US Growth Trust is actually trading at a premium now, which is very pleasing to see if you are an investor in that one after what's been quite a stormy ride. So that's all positive for the investment trust sector, and particularly for growth trusts. And if I look down the list of performers, as I say, it's quite striking this week. I just read down the top 10. We've got CT UK High Income Trust, Schiehallion, Digital 9 has been making a bit of a comeback. That's up around 9% this week. MIGO, another interesting trust we don't talk about very often. That's got a new management and investment approach. That's doing very well. And then we've got a couple of debt trusts. Taylor Maritime, we already mentioned. And also of interest, I think, is Lintel Train Investment Trust has had quite a good week. So these are all growthy things. And then if you look down at the losers, if you like, for example, we could see there Ecofin US Renewables, Gresham House Energy Storage, Biotech Growth Trust. Interestingly, that one's down 5 or 6%. And then we've got some property trusts. Basically, anything that has got any kind of interest rate influence is performing quite badly. So we're in a very binary market, I would say, at the moment. Whether that continues, I don't know. As we come to the end of this year, how would you sum up the year that's just gone, Andrew? I should mention that the Investment Trusts Handbook is now available. It has been published, which covers most of the events of the last 12 months. And you're a contributor to that publication, I should say, Andrew. But how would you sum up the year that we've had?
Yes, I think it's quite a difficult year to sum up because I think there are quite a number of different factors and strands that are pulling in different directions. Because on the one hand, of course, we've spent the year whining and moaning about wide discounts, haven't we? And there doesn't seem any way of shifting those, and they're still at 15%. And so I suppose you can say, well, it's been quite disappointing in that regard, and it's taken an awfully long time to sort out the cost disclosure problem. And actually, the renewable energy infrastructure sector has had a lot of problems, and they're still on these wide discounts. But actually, if you look at the returns overall, and in particular from anything that's equity-based and anything that's had any exposure to the US, of course, then the returns have really been quite good. And that extends actually right across the board geographically. So it includes sectors that we might think have actually been a bit depressed, like UK smaller companies. They've done okay. Europe has actually done okay. So in fact, I think overall, it hasn't been a bad year for most investment trust investors. And I always like to look forward as well. And I think as well, I think this has been a wonderful time to pick up some tremendous bargains, because I do feel that many of these trusts that we're able to acquire at this point on really unusually wide discounts and on very attractive dividend yields. I think if we just exhibit a bit more patience, we'll likely see quite a lot of value being unlocked in those when 2025 arrives.
Yes, well, let's all hope that is the case. It's certainly the case that when I did the sums looking at performance, certainly since the end of September last year, which is when I take as my sort of base case for the data in the Investment Trusts Handbook, it is very striking that the great majority, well over 80% of trusts have delivered a positive total return, and a significant number have produced double-digit returns over that period. So that's particularly striking. 12 months ago, people like Nick Greenwood at MIGO Opportunities were saying this is a once-in-a-generation opportunity. I think what you're saying is that that opportunity set still remains. We don't know what's going to happen to the markets, of course, in the short term. But that opportunity set, even though we've seen these strong gains from a lot of trusts, there's still, we hope, quite a lot to go for.
I think that's exactly right. I think we're part of the way into this really fascinating period, and it's yet to play out fully. So I'm still optimistic.
Very good. Okay, well, on that note, which seems a very suitable seasonal note, we've come to the end of this particular edition. So thank you, Andrew, for your thoughts and comments, and indeed, not just this episode, but others we've had this year. We look forward to hearing how things look when we move into the new year.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.